Let's take a look at the balance sheet. And the balance sheet can sometimes seem confusing, but it's more about logic than anything else. And here's the overall idea. What do you own and how did you get it? The balance sheet shows what the company owns in terms of assets and how the company got those assets. And assets are quote unquote paid for by credit that's been extended to the company from lenders or suppliers. Those would be liabilities, or by the owners themselves, and that would be stockholders' equity. So assets have to equal liabilities plus owner's equity, just by logic. And the balance sheet shows where the company is at a specific point in time. It shows the financial position of the company on the date that's noted on the statement. But it doesn't show how the company got to that position or where it might be headed in the future. It's a snapshot in time. And let's start with assets. Assets, again, are what the company owns. And assets generally are divided into current assets, which are defined as assets that are expected to be converted into cash within a year, and longer-term assets. So let's start with cash. That's obviously the most current asset. And then we have investments that you've made maybe in CDs or short-term investments instead of just holding the cash. And then accounts receivable from customers that your agency billing and collecting from the policyholders to then pass along to the carrier, or for other services that you provided but which customers haven't yet paid you for. Then we have prepaid expenses on, let's say, rent. But some assets are longer term. We call them fixed assets because they don't change in the short term over a year. Furniture, vehicles, things like that. And intangible assets are included as well, such as renewal lists. And goodwill is a longer-term asset that's an intangible asset defined as the excess above book value that your company has paid for the purchase of an acquired company. And mergers and acquisitions do happen a lot in the agency and brokerage space. And then on the other side, liabilities include current liabilities that you expect to pay off within a year, such as accounts payable that are bills that need to be paid within a year, and accrued expenses such as a power bill, and short-term debt or notes that we need to pay back within a year. And then you've got long-term debt and deferred compensation that we know we'll need to actually pay out at some point in the future. And finally, we get to stockholders' equity, which is capital stock and paid-in capital. This is what investors have put into the company. And retained earnings are profits that you've retained in the company as opposed to paying it out as a dividend or a distribution. And retained earnings could be represented and balanced by cash, or maybe you bought a building or a vehicle with the money that you've retained. And some questions you can answer by analyzing the balance sheet include things like, how much cash do we have to cover our short-term debt? How much money do our customers currently owe us? That's accounts receivable. How much do we owe our suppliers? That's accounts payable. How much in debt are we? That's short-term debt and also long-term debt. How much money have the shareholders put into the business? That's common stock and also retained earnings.